and welcome to the latest Insider interview. I am here with Helen Steers, manager of the Pantheon International Investment Trust, ticker PIN on the London Stock Exchange. Helen, thanks for coming into the studio.
Delighted to be here, thank you.
So you own some hotly tipped technology stocks in the portfolio. One that stood out for me was Revolut, the fintech company which does a bit of banking, a bit of stock trading. It's valued at £25 billion, which is similar to Barclays, yet its profits are nowhere near as large as Barclays. So are you worried that private companies have become inflated at the moment, that they're too expensive compared to similar public stocks?
It's a really interesting question, actually. What I should probably say is that Revolut is a company that we own through one of our private equity funds, actually one of our top venture funds. And it's a company that's actually been in the portfolio for some time. And when the private equity manager bought into it, it was a very small business. It was in one of the very early rounds of financing, so long before it became a unicorn. So these sorts of companies we actually get exposure to much earlier in their lives. It's not at the sort of the pre-IPO phase, and therefore, we think that actually we're getting in at this sort of relatively early stage, and therefore, the value will build over time. But we're not particularly worried about one or two of these stocks.
So actually they're expensive because you've made a lot of money in these companies already?
Yes, exactly. I mean, they've risen to the top of our sort of top 50 shares because of the growth in the businesses. They started out really quite tiny. So we've already had a huge amount of value creation actually in that business.
So Revolut is a British company. Are there many other British stocks in the portfolio?
So PIP is a global investment trust, but we do have around 10% of the portfolio which is invested in the UK, and we have some really interesting UK companies. Unfortunately not household names like a Revolut, but actually the biggest company in PIP's portfolio is a Luton-based company called EUSA Pharma. And what EUSA does is it develops and distributes drugs, oncology drugs for the most part, for rare cancers and actually pediatric cancers like neuroblastoma. So very interesting business. We actually invested for the first time, and it was a co-investment, in 2015 alongside one of our specialist US healthcare managers who'd really pinpointed this particular business for growth. We put more money in actually in 2017 and the company has grown enormously. It's developed lots of new drugs, lots of new medicines. It's had them approved by the relevant authorities, and actually it's just been announced only a few weeks ago that the company is being exited, not on the stock market, but to a very large strategic buyer, a big pharmaceutical company that specifically wants this portfolio of oncology drugs.
So that's been a really successful UK investment for you. Are there any others that appear in the portfolio?
There's a couple of others I'd like to talk about. So from oncology drugs to ice cream, we actually own the largest pure play ice cream manufacturer in the world, but you would not have heard about it. It's a company called Frenary, and what it does is it produces private label ice cream for some of the big brands. So it produces ice cream for Haagen-Dazs, for Nestle, for Cadbury's, for Mövenpick. I'd encourage you to go and look at their website. They have a fantastic website with all the top executives all eating a different ice cream. It's quite amusing. So we've owned that company since 2019. It's done exceptionally well. Actually, during COVID, it turned out that ice cream is more of a staple than a discretionary purchase.
That's great. And you said about 10% invested in the UK. Where else are you investing then? Is most of this in America, or are you looking at emerging markets?
So we've got 52% of the portfolio that's currently in the US, and as I mentioned, it is the deepest, most sophisticated market in the world with a lot of very experienced specialist managers who then bring us into their investments. But we've got about 30% in Europe, mostly in Northern Europe. We particularly like Scandinavia, the Nordic countries, Germany, 10% in the UK, France, and then we have a portion that's in Asia and emerging markets.
In a recent note to investors, you said you're expanding more into co-investment, so buying shares directly alongside other private equity funds. You also said you were looking at more defensive sectors like healthcare and IT. So what was behind this communication to investors?
So we like the resilience of those particular sectors that you've mentioned. We also like making co-investments because there we can actually select the assets, and in fact about 33% of the trust is invested in co-investments. Now if you add the single asset secondaries that we do, which is a specialist part of the private equity secondary market, we've got about 45% of the portfolio which is in direct companies, and then the other 55% is in funds. And in terms of what we've been doing recently, we've made some really interesting investments over the last 6 months. Maybe I can mention three of them, which I'm particularly excited about. So here in the UK, we've invested in a really interesting company called Cypher, which is a technology buyout. And what Cypher does is it provides software as a service in the human resources management area. So it provides payroll management, recruitment, things like this, and it's used mostly by UK companies, but often for UK companies that have international operations. And what we particularly like about that sector, and in fact that illustrates why we like software as a sort of resilient sector, is because you've got a very high level of recurring revenues in that particular business. It's very visible, very low churn rate, and this is an essential bit of software to enable companies to operate. It's managing their human resources. So a third UK company that we invested in, actually back in 2019, is a company called Charles Taylor. Charles Taylor is a really interesting business actually, and what it does is it produces insurtech software and services. So it provides services to the insurance management industry, so things like claims management, stuff like that. Quite an interesting business. It was actually founded, I believe, around about 100 years ago, and it had been a small cap stock on the London Stock Exchange. It was taken private in 2019 in a take private by Lovell Minnick, which is one of our financial service specialist private equity managers, and we co-invested in this business. So the company has been doing extremely well.
And is that typical of the technology stocks that you buy? You're looking at very boring things that are going to be the last things to be turned off if a company goes bust. Is that what you look for, or do you go for more racy technology stocks trying to reinvent an industry?
No, it's precisely the former. It's bits of kit, essentially, which keep businesses going. So there's been this move to automate so many different processes. I mentioned human resources management, but you can look in areas such as doctors, clinics, medical practices that need specialist software to keep those practices moving. Even, we've got a business that works in point of sale management. So when you go into hospitality businesses, everything that you see on the iPad there and everything behind it, all the software which is helping to manage the restaurant or the travel business, how they manage their business and their sort of inventory management. So software in general we find really very attractive. We also like healthcare for similar reasons actually. It's very resilient and during different economic periods it's really, it tends to be fairly immune to downturns. So a company that we've invested in recently is a company called Reyes Radiology. This is actually a US business. It's the second largest diagnostic imaging business in the US. It runs about 120 diagnostic centers doing things like MRIs and CT scans covering over 22 states in the US. It's got 120 centers, but and it's the number 2, but there are 6,500 centers in the US. So you can see it's a very fragmented market, and this company is going to do a build-up strategy. It's going to buy lots of other diagnostic centres and get the synergies and basically grow. So we like that business because it's incredibly resilient. People have to have these diagnostic procedures. You can't do without them. And even during COVID, the revenues were deferred rather than lost because people just sort of put off having their MRI scans being done.
And there are some listed companies still in their portfolio. One that I noticed was Chewy. It's an American kind of online pet food retailer. So why are there listed companies in the portfolio? And is there a danger that this is outside of your area of competence? You're a private stock investor. Why are there some listed companies in there as well?
So we don't invest in listed companies. What happens is we invest in companies that then do an IPO. And then what we do is we sell down those stocks over time alongside the manager. So the manager will know really the best time to manage the exit, and we always exit pari passu with the manager. So you may see from time to time some public stocks in the portfolio. We've got, I think, around about mid-teens exposure at the moment, so it's not a huge exposure, and that will just be managed gradually over time.
And there is a performance fee on the investment trust. Can you explain how that works, and did you pay it out over the last reporting period?
There is in theory a performance fee, but it only pays out if the net asset value goes over a certain level. And that level, the basic level, was set way back in 2006, 2007, and over time that level compounds at 10% per annum. So it was set probably at exactly the wrong time for the manager, just before the great financial crisis. It's compounded since then. It's now sitting at a £4.39 level, and in fact our latest announced NAV was £4.17. So we're still a little way off, and every year that high watermark will go up by another 10%.
So actually you set a target which is too high almost, so end investors are benefiting from this.
Yes, yeah.
Do you invest in the trust personally?
Yes, I do, and I've been investing for many, many years. I joined Pantheon in 2004 and started investing in the trust at that point. And actually what I do is what I think many people probably do as well, is I invest the same amount of money pretty much every month in the trust. So I do pound cost averaging, and I've accumulated quite a big holding in the trust. And what I should say is that that's pretty widespread across Pantheon, across the manager. And we disclose actually that 15 of the senior partners at Pantheon hold around, it's just under 2 million shares in the trust.
Helen, thanks very much for coming in.
Thank you, Sam, and thanks for your great questions.
And that's all we have time for today. You can check out more insider interviews on the YouTube channel. Don't forget to comment and subscribe. See you next time.